Hi everyone, welcome back to Santi. Today we'll discuss the factors that affected the recent crash in crypto and equity markets. As you might know, all of the events, all of the factors were connected and it was a chain of events. So we'll try to go along the chain, uncovering all of the important things in simple terms. By the way, a few weeks ago, we discussed an idea of the worst case scenario for Bitcoin if there is no recession. And we concluded that according to technical analysis, 44 to 48K is the worst case scenario for Bitcoin. That was the conclusion of that video, and it happened only 2 or 3 weeks ago. And back in that time, Bitcoin was above 66K, and it was very difficult to imagine that Bitcoin could go as low as 48K. However, as we saw, in only a few days, Bitcoin crashed hard and it went as low as 49K. So it was almost a perfect bounce from the 48K. It was only $1,000 off the mark. This is to point out that sometimes when Bitcoin is in a bullish momentum, or if Bitcoin is above 65K, it's hard to believe or imagine that Bitcoin could go as low as 48K. And I just want to remind us that in that video, we discussed the worst case scenario for Bitcoin if there is no recession. If there is a recession, we had another video for that, the worst case scenario seems to be close to 30 or 31K. So I highly recommend you to check those two videos out because we discussed the technical analysis and the worst case scenarios for Bitcoin's price action if there is a recession or if there is no recession. Two distinct scenarios. And remember that a recession, the topic of a recession is not off the table. And we will discuss a couple of things related to a recession in this video as well. The links to those two videos will be in the description. Please check those out if you're interested in those two topics. All right. So let's start to uncover the whole chain that happened in the last few days. First of all, we need to head to JPY USD chart. Here we see the chart of US dollar and Japanese yen. And you'll remember from the headlines that Japanese yen depreciated a lot lately. And when it reached 262, Bank of Japan started to intervene in the forex exchange market in order to stop this plummeting action of Japanese yen. So by saying intervene, I mean that Bank of Japan goes into the foreign exchange market and then they start to sell foreign currencies, namely US dollars, and they buy Japanese yen. And if you buy your own currency, you appreciate it. So by buying Japanese yen, Bank of Japan started to appreciate the value of their currency. And we can see that here in the chart of US dollar and Japanese yen. At first, when Bank of Japan started to intervene in the foreign exchange market, equities and crypto didn't crush. They didn't react much to that action. However, on the 2nd of August, we had US labor data coming out. And as you might know, the unemployment rate was expected to be at 4.1%. However, it came hotter than expected. It came 4.3. Here we have the chart of the unemployment rate in the US. And as you can see, it's starting to gain a momentum here. And the target rate, which is one of the mandates of the Federal Reserve, is 4%. And if we look back on prior business cycles, we'll see that usually when the unemployment rate starts to gain momentum, it goes up dramatically. We have a couple of instances when it started to go up and gain a momentum. For example, here in 1951 and then in 1952. And we have some other instances as well. However, usually when it starts to pick up, it does it dramatically. So in a few months, it can shoot up. For example, it did something like that in 2007, just before the great financial crisis. It happened in a similar fashion in the dot-com crash. And here you see that it's gaining a momentum and it's currently over the target rate of 4%. And it was expected to be at 4.1%. That's why this was the first part of the puzzle. And along with the unemployment rate, we had some other labor data coming in on the 2nd of August. We had the non-farm payroll, which is a fancy term for new jobs that are created and opened. This was the result for the month of July. Here we have monthly charts. As you can see, the result was that we had a new jobs of 114K. However, the expected amount was 175K. That's a big deviation. It's not a few percentages off. It's a big deviation. That's why the bond market reacted fast. If we go to the 10-year yields, here, if we go to daily chart, you'll see that bond yields just plummeted. And the logic of this is quite simple. When we had hotter than expected labor data, in this case higher than expected unemployment rate and less than expected new jobs created in the month of July, in that case, investors get scared of a recession, of a possible recession. And when you are scared of a possible recession, you move your money from risky assets to less risky assets, usually from equities to fixed income securities. In this case, yeah, a lot of people sold their equities and moved their capital to US governmental bonds. And as you know, prices and yields of bonds move in opposite directions, meaning that if a lot of people buy bonds, the prices will go up and the yield will go down. And here we see that in practice. Only in the 2nd of August, 10-year yields plummeted for 4.6%. A lot of people bought bonds on that day. However, we see a recovery in the yields, as well as we see recovery in the equity market and crypto in general. So after this, after the labor data came in, we had the Sahm Rule triggered. We covered the Sahm Rule in this channel, so you can check the video. It will be in the description. And you can understand how it is calculated, how it's measured, and what is the usage of it. In a nutshell, it's a leading indicator. It's designed to be a leading indicator, however, usually it's not. And its goal is to predict recessions based on labor data. And it's named after Claudia Sahm, who worked in the Federal Reserve. Here we see that the threshold is 0.5. And whenever the Sahm Rule recession indicator goes above this threshold, it means that it signals a recession. Here, if we look at prior recessions, let's go to monthly so it's easier to see. As you can see, it was created actually in 2018 and it was just applied to all the prior recessions. And as you can see, whenever the Sahm Rule indicator goes above 0.5, a recession follows. We had one or two exceptions here, notably this one, which happened in 1959, is an exception because the Sahm Rule recession indicator was 0.6. It was well above 0.5, the threshold level. However, a recession followed only after a year. And as you can see, usually, whenever this indicator is triggered, meaning that it's above 0.5, a recession has already started. It means that it's not a great leading indicator, or maybe you can use it with another threshold, let's say 0.3, meaning that if it's starting to gain a momentum and increase towards 0.3, 0.4, it could signal a recession. However, of course, the accuracy will not be as good as in this case. That's why this is a fake signal. The real signal was in 1960, and it was not a leading signal because a recession has already started when the Sahm Rule indicator moved toward 0.5 level and went above it. And if we look through the history, we'll see that we had another exception or a close call. Here it was just 0.5, not above the threshold level. So it depends on your preference if you want to if you want to count this as an exception or not. However, it went very close to the 0.5 level. In fact, it crossed it perfectly, but it couldn't get above the level. And it stayed at 0.5 for 2 months straight. And after that, it just went down. And when we come to today's environment, we see that it's already sitting at 0.53, meaning that it's already above the threshold level. And because this indicator has a great accuracy for predicting or coinciding with recessions, investors got scared when they saw the headlines that the Sahm Rule recession indicator is already above 0.5 level. This was surely another reason that bond yield started to plummet on 2nd of August after the labor data. And then we had, of course, the recessionary fears based on the labor data. The yields on 10-year plummeted, and we have Bank of Japan increasing their interest rate. Here, let's just now here we see the interest rate decision of Bank of Japan. And as you can see, they hiked on 2nd of August. And they increased their interest rate from 0.1 to 0.25. They hiked for 15 basis points. And the key part here is that no one expected the Bank of Japan to hike. That's why it was very impactful. And now let's speak about the yen carry trade, the most discussed topic as of late. Let's start from the beginning and let's use simple terms. So for the last 25, 30 years, it was very cheap to borrow money in Japan. And this was primarily because the interest rates of Bank of Japan were very low. And the reason for that was that they couldn't hike because, first of all, they almost always implemented quantitative easing and qualitative and quantitative easing, QE and QQE, throughout the years in order to wake their economy, in order to stimulate it. However, they couldn't. And the second reason is that they have a lot of debt. Their debt to GDP ratio is one of the worst ones in the world. And they cannot just increase their interest rates. And as you can see, even in the global financial crisis, the highest that the interest rates went was 0.5. So only 50 basis points. And throughout the years, in the last 25 years, it was usually close to zero. And you will see that for the last 9 years, almost, excluding the last few months, it was at negative 0.1%. Thus, the primary reason that it was cheap to borrow in yen for the last 25 years was that Bank of Japan had relatively low interest rates. In fact, it had almost 0% for the last 25 years. If we exclude the dot-com crash, the great financial crisis, and the last few months. And even during the great financial crisis, they had only 0.5% interest rates, 50 basis points. To put things into perspective, the Federal Reserve had 5.25%, 525 basis points. So that's a big difference. And investors knew this. Investors knew that Bank of Japan cannot afford to increase their interest rate. First of all, because they have a lot of debt, and debt to GDP ratio of Japan is one of the worst ones in the world, and they will need to pay more in interest if they increase their interest rate. So the debt will become more difficult to service. And the second reason is that Bank of Japan frequently implemented QE and QQE rounds in order to stimulate their economy. Because you'll know that in the last 4 decades, approximately, Japan was not the same as before. And Bank of Japan strives to change it. They strive to wake their economy up by stimulating it through QE, quantitative easing, and QQE, quantitative and qualitative easing. By the way, qualitative easing means that Bank of Japan, for example, or another central bank in general, buys risky assets in exchange for safe assets, or vice versa. And that was first implemented in Japan. So that's the second reason that investors know that Bank of Japan will not tighten because they do QE. They want to stimulate their economy. They cannot afford to have a QT round. There is no need to have QT round in Japan. They have the opposite problem. They need some stimulation. And by knowing these two things, investors started to exploit this opportunity. They started to borrow in yen, then they exchanged yen for some other currency, namely US dollars. Then they buy, let's say, bonds or equities by using those dollars. They generate returns on their assets, securities, and after some time they sell those securities. Then they get USD after selling it, and after that they convert their USDs back into yen, and then they repay their cheap loans. For example, it was about 0.6% for the institutional investors to borrow in yen. That's the average rate for the last 15 years, I guess, 15 or 14 years. 0.4%, 0.6% to borrow. And then you can just convert it to USD. You can buy, let's say, US governmental bonds and earn risk-free returns in theory. As long as USD JPY, the currency pair, stays stable. That's the key part, which we'll discuss now. And then you generate returns after 2 years. Let's say you sell your securities, whether it's bond, whether it's S&P 500, and then you just convert it back to yen and repay your loan. That's how the system works. Here is the key part. This system works as long as Japanese yen doesn't appreciate with respect to USD. Because, for example, if let's say 10 US dollars equals to 1,000 yen, let's say you borrow 1,000 yen in Japan, convert it to USD, you get 10 US dollars, you invest it in S&P 500 and generate 20% in 2 years, you have $12 now. However, if the Japanese yen appreciated, means that now you need to pay more US dollars in order to buy the same amount of yen. It depends, of course, how much it appreciated. So this system, the yen carry trade, works as long as yen is stable with USD or it depreciates with respect to USD. If it depreciates, it's much better. Because now, after 2 years, when you go back and you want to buy 1,000 yen in order to pay your debt, instead of giving $10, you give $8 and get the same amount of yen. It means that you generated $2, which is 20% of your income, initial income, from the security, let's say S&P 500, and you got also another 20%, which is 20% return, $2, based on the depreciation of yen with respect to USD. And another key part here is that as long as a lot of people borrow in yen and the number is growing, yen in theory should depreciate. Because whenever people borrow in yen, the first thing that they'll do, they will sell the yen in the foreign exchange market in order to buy USD or some other currencies. And whenever they sell those yen just depreciates. So there is a constant sell pressure. And as long as we have more people coming into the carry trade, the yen carry trade, we are safe that the yen will depreciate, at least in theory. And that's what happened for the last 25, 30 years. And here is the problem. When it starts to appreciate, you realize that you will need to pay higher amount of US dollars for the same amount of yen. So if you are risk averse, it's better for you to just pay off your loan. So that's what happened a few days ago. Here is the story. First of all, about 3 weeks ago, Bank of Japan started to intervene in the foreign exchange market, which we saw in this chart. Let's go to USD JPY. Here, around 3 weeks ago, officially, the Bank of Japan started to intervene in the foreign exchange market, which they do occasionally. It's not the first time. They do it frequently. However, usually it has no effect because there are it's estimated that yen carry trade is about 20 trillion US dollars, the equivalent of 20 trillion. And the foreign exchange reserves of the Bank of Japan are kind of negligible. You cannot sell enough in the open market, in the foreign exchange market, to have some effect. That's why usually their interventions either do not help or they just help temporarily. But this time, they intervened and it seemed that it helped because at first it started to have some effect. And Japanese yen started to appreciate with respect to USD. And then on 2nd of August, the data came in for labor statistic in the US, and it was hotter than expected. And a lot of people got scared of a recession. And they just started to sell their, let's say, S&P 500 and just pay off the debt in yen if they are risk averse. Moreover, Bank of Japan increased their interest rate, which was very unexpected. No one expected that they'll hike. And after they hiked, it means that the debt will get more expensive. And when country increases its interest rate, its currency appreciates. QT means more expensive currency. And whenever they started to increase, whenever the Bank of Japan increased their interest rate, people, investors realized that it means more expensive yen, appreciation of yen, which is bad for them. So a lot of investors just started to sell their assets, which was bought from the yen carry trade. And actually, they have everything. Like those assets include both like crypto, equities, bonds, all types of securities, everything. The market for yen carry trade is estimated to be more than $20 trillion. It's just almost the GDP of the US. It's very huge. So a lot of people started to sell in order to convert it to USD, then convert USD into yen and pay off their debts. Because if they don't do it, they'll need to pay more in 1 year, let's say. That's the simplest way to put these things together. Intervention and Bank of Japan started to increase rates, which means more expensive yen. People just sell their assets, which was bought through yen financing, and then they just want to pay off their debts in order to have less losses. And then the practical effect is that there is a sell pressure on almost all assets, equities, crypto, and even gold. So some sell pressure. On 2nd of August, gold went down. It was very strange. However, it was written in some articles that gold went down because a lot of people just sold their gold in order to cover other positions in equity markets, in order to pay for margin calls. It's a very interesting story. So that was the practical effect of the yen carry trade. And the most important thing here is that it's a spiral. Because when people start to sell their assets and convert it to USD, and after that they just trade USD for yen, they start to buy yen in order to pay off their debts in yen. And when they start to buy a lot of yen, yen starts to appreciate. This chart goes further down. And if it goes down, it means that more people will like to sell. So more people sell their equities or securities, they convert it to yen. When they convert it to yen, yen again appreciates. And it's a spiral and it goes all the way around. So, and then you get the logic. It just goes down, down, down. And then why we saw this action from the USD Japanese yen. Here we see that for the last 3 days, yen started to depreciate again. This is because the Bank of Japan stated that they will not hike again. As long as the markets are in this kind of condition, they will not hike again. That was an official statement. So after that, investors started to borrow in yen again. So the demand for yen started to be less than the supply. And then another news was that the Treasury in the US will buy back its treasuries for $50 billion starting from this month. It's not an official statement yet, however, there are a lot of rumors about it. $50 billion of treasuries in 3 months. Most of those were in September. That's another news that changed the direction of the USD JPY. After those two news, which happened in the same day, it was 6th of August, yen started to depreciate again. However, we see that it's relatively stable as of now, so we still need to wait and see how this unfolds. And you'll know that the markets recovered a lot, especially like the crypto, like Bitcoin recovered a lot. Just before the crash, it was around 65K. It went down for 24.5%. And now it recovered for like 16. Yeah, for now, yeah, it's close to 16%. It's a huge recovery rally. And we see that like in general, altcoin market recovered substantially too, which cannot be said for equities. As you can see, equities are very close to their lows. And it's the same for almost all of the Magnificent Seven assets. Like Nvidia is down, Tesla is down, and all of them are very close to their local lows, local bottoms, which happened a few days ago. And interestingly, gold is not rallying hard. That's another interesting thing. Because when we have recessionary fears and when we have such uncertain periods, when no one knows how the carry trade will unfold, how it's going to end up, like whether we will have a recession or not. In this kind of situations, gold usually rallies because people sell their other assets, equities, and some other risk assets. They convert those, they move that capital into gold. This time, we don't see anything in gold. It's interesting. However, we see that Bitcoin is in a great recovery rally. It had a 16% rally in only 4 days. Isn't that wonderful? Yeah, it's great. And when it comes to recessionary fears, it's important to be open minded because a lot of people said that we will have a recession in 2022. And after that, they just forgot because all of the markets, like every market, Bitcoin, then we have the S&P 500. A few months ago, we had Nikkei 225, the Japanese index, gold. All these assets had their all-time highs in 2024, and people were very bullish. And they started to forget about some indicators which showed us that we might have a recession in the US. Notably, like the most important indicator maybe is the yield curve, the inversion of the yield curve. People just forgot about those. And there are plenty of indicators showing us that there is a higher probability that we will have a recession in the end of this business cycle. We need to be like open-minded. We shouldn't exclude the possibility of a recession. I know that a lot of people couldn't imagine that Bitcoin could go down in a few days only, in less than 2 weeks, from 70K to 49K. That's a 30% decrease. Yeah. And how many days we have between these two events? So 7 days in a week. 30% down in a week. When it was close to 70K, everyone started to speak about like new all-time highs. But we had a video in this channel and we discussed a possibility, the worst case scenario for Bitcoin, which was not guaranteed, of course. That was the worst case scenario. If there is no recession, and it was from 44 to 48K, because based on TA, we saw that if Bitcoin loses the 61K zone, there is nothing to hold. There is no zone between 48 to 61K. There's no potential key support and resistance zone in this range from 48 to 61K that would hold it. And we saw that it was the case in this turmoil. When we had some bearish events, bearish news, which started due to the labor data, which came hotter than expected. And then the chain started to unfold with the yen carry trade. We saw that, yeah, after losing the 61K, Bitcoin was in a free fall. In only 2 days, it went down more than 10K and it went very close to 48K, the zone that we indicated in that video. So, for this reason, we should be open-minded to the idea of contractions and a recession as well. And recently we discussed the household and business leading indicators, which show us and hint to us that there is a real possibility of a recession. In those two videos, we compare the indicators of household and business sectors of this and prior cycles, which clearly show us that there are some cracks opening up in the US economy. And we should acknowledge those. Thus, we should wait and see how this unfolds. Because there are a lot of analysts that predict that the yen carry trade could resume, meaning that yen could start to appreciate with respect to USD again, and the spiral will go on. Make no mistake, this doesn't mean that this was it and from now on the markets will be green. No, it could. However, there's a chance that markets would have a second leg lower. No one knows. And we should not exclude the possibility of a recession. If or when it comes, it's not going to be good for equities, for crypto, altcoins especially. That's why it's better to be open-minded, and we should have some strategy when it comes to Bitcoin buying or deep buying or selling. And you should not be surprised to see Bitcoin trading at, let's say, 40K in a month or in 2 months' time. It could certainly happen. The same way that people couldn't believe or imagine that Bitcoin could trade at 48K only like 10 days ago when it was close to 70K. The same way a lot of people cannot imagine that Bitcoin could go as low as 35 or 40K, let's say. But if a recession arrives, chances are that Bitcoin will go as low as 40k or 35k. It could happen. So, this was the chain of events that affected the markets for the last couple of days. I believe that we covered all important ones, all important factors. Thank you for tuning in. Please let me know in the comments whether you think that this was it and from now on we will see a recovery rally, or you believe that we will have another leg lower. Please like and subscribe, and I'll see you next time.